Welcome back to Simply Money. Today, we're going to be talking about my five favorite ETFs, and we're going to work our way up to my number one favorite ETF. So stay tuned to find out what that is. So, welcome to the live broadcast here. And so, here's what we're going to do we're going to see what is the right ETF for your portfolio. Now, I'm going to share what my favorites are. And I want to precursor this with I am not a financial advisor. This is not financial advice. I'm not telling you to go buy these ETFs. I'm telling you why these are my favorites. And I think some of them may be good for a lot of people, but as I always say, finances are personal. We were talking about personal finances. And what I'm doing as a 56-year-old person is going to be different than what you will do if you're 66 or if you're 26. Also, what are your goals? What is your purpose of these investments? So you have to consider a lot of different factors other than what I'm going to share here today. So, if you want to know what the right ETF is to supercharge your portfolio with growth, with income, and stability, stick around because we're building up, like I said, to my all time favorite ETF that could be maybe a cornerstone for your strategy as well. So as you come on, go ahead and hit a thumbs up in the comment just so I know you can hear me. And we're going to, just kind of get going as people start coming on. And I want to welcome everybody here. I appreciate you joining me. I appreciate those that support the channel with your viewership, with your comments, with your input, helping the community. It's a great way to share with each other. And I appreciate from, just like a state or country that you're from helps us kind of see where everybody's coming from. Even if you want to maybe throw in your age, that'll help us as we're talking and maybe giving some guidance or input or advice to each other. Like I said, because what I'd suggest for somebody who's 56 like myself would be drastically different than what I'd suggest for somebody who's 66. And even myself at 56 depends. Am I planning on being financially independent and using this portfolio next year, or am I going to be waiting till I'm 70 to use it? Because 14 years makes a big difference on the strategy I might take. So let's get started with some of this information that we have today. Um, and let's just face it that picking an ETF is hard. There's hundreds of them out there. And to know how do you know the right one? How do I know if it's a good expense ratio and all these different terms? And again, that's why I have this channel. The reason I began doing this channel is just to provide financial literacy to people and for myself to continue to grow and learn as I communicate with other viewers, as I watch other YouTubers and creators, as I interact and I learn. And it's a great sharing opportunity. But my whole purpose is to help provide literacy for finances for people because it's sadly missing in our society and it can be overwhelming. So, even like now, if I say, you need to just have a couple good ETFs in your portfolio, there may be somebody listening saying, "What's an ETF?" And so I hate sometimes to just assume people know everything we're talking about, but I also can't go over everything every video because we want to get into some of the deeper stuff. I have videos on the channel if you want to check out like what are retirement funds, what are ETFs, what are stocks, what are dividends, all those types of terms that you're going to be hearing. There's a lot of jargon and some of it's confusing. But here's the truth finding ETFs that work together to balance growth, stability, and income doesn't have to be that complicated. I've done the heavy lifting for you tonight as I'm going to be exploring five ETFs that could make a real difference in your portfolio. Let's see. So let's start with number one. And the reason I picked this particular fund is because I think somebody just getting into investing and they don't know where to begin, I think this is a great place to start. If you're, it doesn't matter what age you are, really. If you're just starting, though, and you're like, I need to start putting some money into investing for it to grow. I think this fund, if you were only to pick one fund and go solely with a fund, I think this is a pretty good one. Now, I have some alternatives I'll share and some reasonings, but let's just start with FXAIX. This is Fidelity 500 Index Fund. So all this is a fund comprised of 500 of the largest companies in the S&P 500 in the stock market. It's 500 companies, and they're weighted by market capitalization, by how much they're worth, basically. And so let's go through some of just the numbers real quick. The expense ratio on this. Um, hey, what's up, Brandon? Good to see you, buddy. I'll read over some of the comments here and there. I'm not great at multitasking, trying to make sure I stay on track, making sure I'm still looking at the camera and then also reading notes. One of these days, I'll get big time on YouTube and I'll have my headphone on and I'll have my editor in chief whispering, hey, Brandon just said, "What's up, boss?" And I can say something, not even have to look down. But for now, I'm doing it all. I am a solo show. So expense ratio, a big thing. One of the things you don't want to lose in your investment is your own money. You don't want to be paying it to an advisor or this is where mutual funds come in. They're actively managed. So they take out management fees. And sometimes those management fees may seem small, especially when you're starting out. 1% of $1,000, you're like, oh, it's not that expensive. But if you grow your portfolio to $500,000 to $1 million, you're paying 1% annually for that. That adds up quick. Then you start putting it into dollar amounts, and you're like, over the years, how many dollars have I paid in these fees? And then not only the dollars did you pay, but what those dollars could have been compounding throughout the years, you've lost that as well. So keeping as much of your money into these funds as possible is important. And the expense ratio is something I look at. And this is a 0.015. You're not going to get much lower than that. It's almost free. It's a very minimal expense ratio. You're not paying a lot there. And when you look at the return on these, I'm going to be looking at the 5 and 10-year return, because I really don't care what 1 year's done. And I don't really care what 2 years done. So I start with 5 years. And I'll look at 1 and 2 years for myself, but sharing with others, I'm like, if you're investing and you're concerned with 1 year, you shouldn't be investing in the stock market. You should not be investing in ETFs. Put it in a high yield savings, a CD, something liquid that you can get to that doesn't have the fluctuation. Because if you have a 2-year down market and you need the money in a year and a half, you could be screwed. This isn't where you put your money for a down payment on a house or something you're going to need in the next year or two. Stock market should be for 5 years and beyond, in my opinion. So the 5-year return on this has been 11%, and the 10 years been 12%. So if you held this for 10 years, you would average 12% return each year. Now, a lot of people think it's like this linear, just 12%, 12%, 12%. That's not how it works. If you look at this year and last year alone, 2024 and 2023. If you look at those 2 previous years, the S&P 500 has returned over 20% 2 years in a row, which is very unusual. Hasn't happened, I believe, since the 90s. So it's been a really strong market. And most of that has been driven by the tech industry, especially the Magnificent Seven, NVIDIA, Google, Facebook, Apple, those big companies at the top, because they hold a lot of weight and they have just driven the market really hard, which is great. And that's how it works, because that technology sector, and that's a term you'll need to understand and know, because when we talk about diversification, you have to understand sector as well as capitalization. We don't just want 500 companies. We want to make sure we're in different sectors, because right now the S&P 500, the technology sector, has really driven the market, which is good. But there's going to come a time, it happens all the time, more frequently than people realize, that the market will drop 10%, 20%. And that happens on a regular basis. I don't remember the statistic exactly. It's somewhere around 48 or 49% of the time each year. If you were to take each year, there's a 10 to 19%. Sorry, I have to get my numbers straight. 10 to 19% drop in the market. That's on a regular basis. And now it recovers, but during that year, it dropped at some point 10 to 19% almost half the time. So if you hold the fund for 10 years, 5 of those years, you're going to probably see a dip of 10 to 19%. Think about that. If you have $100,000 and you go ahead and have a 10% dip, now you're down to 90,000. Again, just like expense ratios, as that portfolio grows, if you're sitting at $1 million portfolio and you have a 10% drop, you just dropped $100,000. And that becomes a really hard pill for people to swallow. And so I want you to understand that that is normal. I have a video coming out on the 8th of February on the odds of losing money in the market based on how many years you're into it. I think it's really fascinating. Make sure you hit the subscribe and that notification bell. So when that comes out, you get notified and you can watch that. I think it's really interesting to see how you kind of take the gamble away the longer you're in the stock market. And I break down the explanation of some of that for you. So fund number one, ETF. Let me stop here real quick. We got a question, Brandon. Let's see. Diversification, is that what you mean by different sectors? Diversification, I actually mean several things. One, when we talk about diversification, we mean multiple companies. So the first thing you want to do, and that's why I don't promote single stocks. So let's say you really love Apple and you want to buy Apple. Well, now you're in one stock, you're one company. If that company does great, which sometimes you pick the winner and you do great, but sometimes that one company does really bad or they have a period where they're struggling. Something recently, a really strong company, it was a dividend king or dividend aristocrat, I can't remember, 3M. Great company, long term, amazing dividend payments, all sorts of stuff, but it had some lawsuits come up and it really dipped for a couple years. It's starting to recover now. They've settled some of that. But for those few years, if you were just in 3M, one company, you would be really down. And I've shared this before. I'm a little bit older. I remember companies that were up and coming. If you think about back in the 80s, Kodak was the big thing. Everybody had a Kodak camera. Kodak was a huge up and coming company. But then when digital came out, they didn't keep up. And you don't hardly hear of Kodak anymore. They're still around, I believe, but they're definitely not going to make you rich if you'd put all your money in them back in the 80s. The problem with not diversifying in one company investment is people tend to think, oh, well, I'm going to pick, Nvidia. If I had got into Nvidia in 2010, look where I'd be. Yep. If I'd got into Apple, I think about Microsoft when it came out, Facebook when it came out, all of those. Hindsight's 2020. That's not how the stock market works. So diversification starts with more than one company, and that's why index funds, ETFs, and mutual funds, they're basically a fund made up of various companies. This one I just shared, FXAIX, is made up of 500 different companies. So I'm going to do something real quick. I'm going to share my screen because I want to show you something here. And this is what I use. It's just if you go to Yahoo Finances. So hopefully you can see this. Oops, not if I change it, you can't. So here you have Fidelity, FXAIX. This is the summary page. And so here you can just see the performance. This is a 10-year performance. We like seeing that green going up to the right. But the thing I want to show you is the holdings right here. If you go to holdings, now FXAIX is diversified. It has 500 companies. But if you look at this right here, the top 10 make up basically 35% of the fund. So you're diversified. And so index funds and ETFs sometimes can be deceiving because you think, oh, I'm diversified. I'm in 500 companies, but you have a third of your money in 10 companies. So you're not as diversified as you think. The other 490 companies slowly fall down as you go to the number 500 company. That's probably 0.001%. So if you put $100 into FXAIX, you're basically putting $7 into Apple, $6.50 to Nvidia, $6 to Microsoft. So you can kind of see how you're diversifying, but you're very heavy in these 10 top holdings. So that's something we'll be looking at in these other funds as well. And then here in the sector weighting, Brandon, to your question, the second part of diversification that I look at, and I think that people sometimes miss, is the sector. You have technology, which here in this fund is making up, again, 33% of the fund is in technology. Then you have financials, consumer, cyclical, healthcare, and you can go down here as you see, like real estate makes up 2% of this fund. So there's some diversification in sectors, but again, you're pretty heavy in the technology. So we will look at this some more as we continue on. Oops, don't want to show that. Look at my ugly face all over. So as you see these funds and you see the diversification, that is, you can't, can you see it now, Brandon? Sorry, here I am yapping. I was on the wrong screen. You didn't even see me. Can you guys see this? Give me a thumbs up. Okay, sorry. So again, real quick, you have the Apple. You see the diversification here is heavy in this one uh, top 10 holdings, and then your sectors. So we'll get into this more as we go further on into these other ETFs. So let's go to my second favorite. This one is the iShares Semiconductor SOXX. Now, I'm going to say this carefully. I do not recommend you investing in this unless you have a small portion of your money that you, and I'm going to say this, don't care about. Obviously, we care about it. I don't think you're going to lose all your money, but this is a very volatile sector. This is my favorite. I want to put a little bit into something that has a lot of upside. I know the floor, the downside is much lower as well. When you talk about volatility, it's what they call the beta. Beta of 1 is what they base off the S&P 500. So if it has a lower than 1 beta, it means it's not as volatile as the S&P 500. FXAIX would have a beta of 1 because it is the benchmark. The semiconductor that I like, SOX, has a beta, I believe it's 1.72. So that is a little bit high, meaning it's going to be very volatile, meaning it's going to go up probably a lot more, but it's also going to go down a lot more. As you can see here, let's look at FXAIX summary and see this 10-year. And you, other than, you know, a couple big markets, you see some pretty good dips and all. There's some movement there. It's up, 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 and there's some, you know, pretty good movement down. But when you go to SOX, SOXX, you can see some really, let me get further out, you can see some really big drops like right here, but you can see some hyper growth as well. The reason I like SOX is because this is 30 companies. This isn't 500. This is 30 companies focused on AI, semiconductor, 5G technology. This is completely not diversified in the sector that I just talked about. Has a little bit of company diversification. This is my, I want to buy NVIDIA or Broadcom, but I don't want just one company. So I want to put my money into various companies in this field. So when you go to the holdings, you can see that the top 58% is in 10 holdings. As you can see, Broadcom, NVIDIA, you have some of these companies, and they are, why is my screen not sharing? Sorry. So you have these companies that are really able to have a lot of growth. The expense ratio is 0.35, so it's a little higher. But look at this. The 5-year return has been 25%, averaging 25% for 5 years. And for 10 years, it's been averaging 22%. And here's why I'm in it right now, is because obviously there's a lot of upside possibility with AI microchips. So I see a lot of upside for SOX. Again, this is not something I would recommend you putting as part of your portfolio as a big balancing part of your portfolio. For me, this is a little bit of that. I want to put a little money in for some hyper growth. If I lose it, I lose it. My other funds will balance it. But the good thing about ETFs, I'm not going to lose everything. I may have some downsides. I may see some things really drop, but I'm not going to lose it all. So SOX is heavy, heavy technology, 100% technology sector. So if you go back to the sectors on the Yahoo Finance, it's 100% in technology. There's no other diversification. So it's a minimal diversification in companies and zero diversification in sectors. So that's my second uh, holding in my portfolio that I like. I shared with someone the other day. I have some holdings in my portfolio. I don't really, they're not my top choices. I think they're decent, but it's because that's all that's offered. If you're in a 403B, a 401k, you're very limited on what you have. I recommend those though. If that's what your company offers and you have a company match, you want to get that free money. Um, but if you don't have that, I recommend using a Roth IRA if you are under the contribution or the income limits, or traditional IRA, or you know, to have more control of that and what you can invest in. So FXAIX number one for just people getting in, they don't know what to start with. It's a great way to get into the 500 top companies and see some good growth with good diversification. SOX for me is a get in, here's some opportunity for growth. Now, my third, and this is for me, I really don't recommend this for a lot of people unless you're at a place where you're getting ready to retire or living off of your portfolio. I'm big on dividends. I love dividends, and I plan on, when I finally say, you know what, I'm not going to work anymore, I'm just going to use dividends and not touch my principal. Um, but I don't think you necessarily have to start with dividends when you're 25, 30 years old so that you get that dividend growth. I think they're good and they have a good place if you have the right fund. But your growth in something like FXAIX or some of these other funds that I'll show you in a minute will be much greater, and then converting to income driven dividend income uh, ETFs later as you get closer to needing that. There's a lot of opinion on that. That's just my opinion. If I was 25, I wouldn't be focused as much on dividends at this point because I'm not going to be living off of it. Again, I'm 56 and I'm going to be drawing off of it any day. Who knows when? Uh, just when I'm at the point where I have the FU money, and it might be today, might be tomorrow. But the third fund here is JEPQ, JEPQ. This is a covered call ETF. It's in the tech sector. I get a lot of exposure to the tech sector, but it pays a 9 to 11% dividend and still has some upside growth. If you're not familiar with dividend traps, be careful when you're looking at dividend yields and you see things that have these 12, 13, 14% dividends, and you think, oh, that's awesome. But meanwhile, the growth of your stock, your portfolio is going down because you're losing value and it's not growing. I like dividends that pay and the dividend grows, but also that the value of the shares go up for share appreciation. Let's see. Is it good to put a dividend ETF in a Roth account so that the dividends can just be directly reinvested and you don't pay those taxes? Yeah, great point, Brandon. Um, so that's one of the downfalls in this JEPQ is they're not qualified dividends. Now in a Roth, they will be. You can invest them, reinvest them automatically and buy more shares. When you go to take them out, they won't be qualified dividends, which are taxed at a lower rate. Another reason why I like dividends is because the tax rate on dividends is much lower. But just like a regular dividend, let's say you just had Coca-Cola, it's a regular qualified dividend. If it's in a Roth, an IRA, 401k, any of those, as long as they're staying in there, you're not paying taxes on those while you're reinvesting them. So you want to set that drip up automatically dividend reinvestment plan. Just yes, when they pay the dividend, it automatically buys more of that same share. Um, But if you have it in a non-taxable or in a taxable broker account, um, a few years I maxed out my 401ks, Roth, or sorry, my IRAs, my HSAs. I had nowhere else to put money that I wanted to invest, so I put money into a taxable account. Those are things I don't want, like this JEPQ or other dividends, because every time it pays a dividend, I'm paying taxes on that. Um, some people will get the dividend out of that and then reinvest it into like a Roth or something. Um, and again, there's a lot of things. This could be a whole nother episode for why you'd want a taxable account, because if you want to retire before you're 59 and a half, you need some funds to be able to tie you over until you can access your 401k, your Roth IRA, those funds that are tied up because of the retirement age of 59 and a half on those without paying penalties. So again, a lot of little nuances to think about, but not paying taxes on your dividends is a big one. JEPQ, again, this is for me because it is dividend growth. I combine this with my socks into this category. I want something to give me some income, but this is not a big portion of my portfolio. Something that I'm using at my age because, $50,000 is providing me $5,000 a year of income. And that's just each month I'm getting a paycheck of 10% off of that, and it's appreciating. The share prices are going up. Um, they're increasing. Has a 5-year returns not available yet because it's a newer fund, but it has a big brother, JEPI, JEPI, which has done very well and has some market appreciation as well. So these two funds, SOX and JEPQ. For me, I like them because they fit into my short-term goals and what I'm doing right now. And I like JEPQ because it's driving some income without depreciating my investment. And I'm taking those, I'm not actually buying more JEPQ. I'm flipping those into some other funds that I'm going to share here in a moment, just adding to my share building of those. So again, everyone has a different approach. At some point, when I finally pull the plug and say, okay, I'm going to live off my portfolio, I may put, a good 10, 15% of my portfolio into JEPQ to help drive up my dividend yield. That way I don't touch my um, principal in my portfolio. That's my goal. Is I don't ever want to touch my principal. I want my dividends to provide me not only the income I need the year I retire, but to grow at least at the rate of inflation each year after. So my um, spending power continues to grow with me. And also my portfolio at least stays the same, but preferably grows. So then I can leave a legacy for my kids. And if they're listening, you're welcome. Yeah, I could go by the book of, die with zero and just figure, like I'm going to spend everything I have. And when I die, I think the book goes into like, I want to bounce my last check before I die, like spending down your portfolio. I don't want to live like that. I do want to leave a legacy for my kids. They're not going to be inheriting any Lear jets or anything, but I'd like for them to be able to, you know, come to my funeral and go, "Oh, nice check. Thanks, Dad." That's kind of where I'm at and why I want to live off dividends completely. So that's fun number 3. Now, the next two funds I'm going to share. This is, again, all this is my opinion. If you weren't here when I started, this is not financial advice. I'm not a financial advisor. I'm not telling you what to go buy. Um, this is my opinion and my reasoning for why I'm doing what I do. But these next two funds, if I was 25, 35 years old, I would probably have these two funds and that's it. This is just me because I like it simple and I'd want to put as much into these two funds as possible because I believe they mesh together really, really well. And one other thing that we'll talk about here in this episode is fund overlap. You can get a lot of diversification, but you don't realize you're getting a lot of overlap. What's in this fund is also in this fund. So you have 20, 30, 40, 50% overlap. And so really you're not diversifying much more. You're just getting a lot more of the same stuff just from two different funds. And so you're just piling more into it. So the beautiful thing about these two funds is there's basically no overlap. One is going to be really growth oriented, and the other one is income oriented, but has a nice growth element to it. So here we go. Number 4, SCHG. This is the Schwab US Large Cap Growth Fund, and it has an expense ratio of 0.04. Let's see if I can share this here. See if this will open up to you. Tell me if you can see this for me. I don't know why. No, still not doing it. Let's see. Let's try this again. All right, there we go. Can you see that now? There we go. The growth ETF. So as you can see, this is a Schwab large cap growth. It has an expense ratio of 0.04 for 5 years. It's averaged 16% return, and for 10 years, 14%. And remember, we talked about the beta, its volatility is 1.05. So it's very similar to the benchmark of the S&P 500. Slightly more volatile, meaning it has a little more upside, as you can see with the 16 and 14% return, and the downside would be a little bit lower. But this has been a great fund, and for me, it blends really good with my favorite ETF that I'll be sharing in a minute. But this is the holdings. Can you see that? Nope. So YouTube's screen share is really wonky. So here we go. The holdings. As you can see, look at that. 62% is in the top 10 holdings. So this is not diversifying like we talk about. So you wouldn't want just this fund. That's why if you're only going to go with one fund, I'd recommend FXAIX. You get 500 companies, 5% is in the top 10 holdings. So a little more diversified, not quite as heavy in technology. As you can see, you're really heavy into technology here. Some of the big hitters, Apple, Nvidia, Microsoft, Amazon, Meta, the Magnificent Seven right there. Look at that, 12%, almost 13% in Apple. $100, you're putting 13 of it into Apple. Half of your fund is in technology. So not real super diversified here in the sectors either. But you'll see in a moment why I like this. I would not buy this as a solo fund. If you're only going to have one fund, FXAIX, or even a full stock market, if you really want to diversify, like VTI, I think it's VTI. I'm sorry, I'm going blank here, but a total stock market where you have 4,000 companies and you're diversified in everything, you're not going to have as much upside, not as much downside, and you're definitely diversified. But for my 2-fund portfolio, which I like, and this is where the bulk of my money is in this SCHG and the one I'll show you in a minute. And then those 3 I've shared with you prior, FXAIX, JEPQ, and SOX, are just a small portion of my funds that I have for some growth and for some income, excitement, and some stuff I'm doing. But this is a really cool fund, and the portfolio mixture is interesting when you go to the 5th one that I want to share here. And I'm going to skip real quick to that because let's get over here to my favorite. If you think you know my favorite, a couple of you I think do. My favorite is SCHD. And this is based on many factors. Factor 1 is my age. I'm at a point where I'm at any time going to be using the dividends to live on. And so I'm just at that point where I have a large portion of my funds in SCHD. This is an income driven ETF. There's about 104 companies, so it's pretty diversified. And I want to show you this funding of this. Um, Come on, computer. The holdings, because the holdings on this are what I like. Let's look at this holding. So 100 companies, 41% of it's in the top 10. But look here, see, everything's at 4%, 4%, 4%, 4%. Its diversification is very simple, and they have the rules that they use to balance this is at the end of the quarter, they'll rebalance, and anything over 4% will get brought down to 4%. And likewise, over here in the sectors, see how even this is 18, 16, 14, 11, 11, 10. It's not heavy in one. And as you can see in this one, technology is way down here because SCHG is 50% technology. SCHD is only 10% technology. These two blend really nicely. And out of these 100 companies, you are really deeply diversified. You're not putting a lot in the top, one or two companies like SCHG. Apple has 12, almost 13%. And this is going to get rebalanced where it will go back down to 4%. It's above that because of the growth since it was last rebalanced, but it automatically rebalances. Same with sector weighting. It doesn't allow anything. I believe it's 20%. Nothing can go over 20% weight. If so, then they rebalance. So all the different rules to keep things balanced. But SCHD has a 0.06 expense ratio, so really cheap. 5 years, it's averaged 12% return, and for 10 years, 13% return. But while doing that, it's providing a 3.6% dividend yield. Every quarter, I get a 3.6% payment based on my portfolio balance. But even more importantly for me is the dividend growth. It's called the CAGR, CAGR, compound annual growth rate. How much does the dividend grow from the last year? So for 12, I think 12 or 13 years consecutively, SCHD has grown its dividend. See, JEPQ, which I just talked about a minute ago, has a 10% dividend, but it doesn't grow. Sometimes it goes down a little, but year over year, it doesn't grow. So in 10 years, I'm losing buying power. I'm still getting the 10% off the portfolio growth, but the dividend is not going to be growing in the same way. With SCHD, it has got about a 12% CAGR, meaning the dividend grows approximately 12% year over year. And just like price appreciation, it doesn't just go 12%, 12%, 12%. Some years it's a little lower, some years it's a little higher. I think the worst year was 3%, but it's also had a 20% CAGR. And you'll see some of those fluctuations, but it's gone up, meaning that you get a pace. This last year had a 12% from the year prior, 12% dividend growth. And it's also providing a 12% return on the appreciation. So let's just say I decide to retire today and I start taking out my SCHD dividend. Next year, the dividend I'm getting this year is going to be more next year to keep up and outpace inflation. So it's like next year I'm getting a 12% raise or a 10% raise, whatever the dividend growth rate is. Meanwhile, my portfolios, I'm not selling shares and it's appreciating by a rate of about 12% per year. Now you take out the dividends, so the growth is only maybe about 9%. Still a really good growth rate while you're pulling out 3.5% dividend year over year. Diversified. And if you take this with SCHG, you have zero overlap. I want to show you an overlap tool I use right here. It's called dividend overlap, or sorry, fund overlap. Let's find it. There we go. So if you plug in SCHG and SCHD right here, you hit find overlap. Look at that, 0%, 0%, meaning that when I get SCHG and I get SCHD, I'm getting diversified even more. And they're balancing SCHG with this high tech focused, growth focused, a little more volatile, with SCHD, which is much more diversified and kind of the glue that holds it together. Its beta is 0.9, so it's not as volatile. 2022, when SCHG, FXAIX were down like 20, 25%, SCHD was only down 6%. Still down. Doesn't mean it doesn't go down, but it helps balance that. So I didn't see that huge drop. And if I was 25, I wouldn't worry about the huge drop. In fact, I'd be excited because I'd be like, find some cash, put it in, it's on sale. But when you're going to live on your portfolio, those big dips can be a little bit more scary and cause you to lose a little more sleep. So I like SCHD because it balances that and still has great growth. I don't think anybody, if you told anybody, look, if you invest X number of dollars and for the next 10 years, you'll average 12% return, I don't think anybody would be discouraged by that. That's what SCHD does for you. It provides great growth and income with income growth. I'm going to throw SOXX in here for the fund overlap, just to give you an idea. So as you can see, SCHD and SOXX, not bad. There's a little bit of overlap. So you're still a lot of technology, but different technology. So here's the big overlap with NVIDIA, Broadcom, but the rest of the fund, you're getting, 87% more exposure into technology by combining stocks. So I wish there was maybe there's out there, if you know of one, a fund portfolio like this, overlap, that you can put multiple funds in to show the overlap of all of them. That would be really cool. I've done this with all the individuals to kind of see the overlap. Obviously, JEPQ and SCHG have a lot of overlap. Let me see if I can throw that in just to let you see that. 23% on there, 53% of JEPQ's 103 holdings are also in SCHG. So you're not getting as much diversification. The difference is with JEPQ, it's not about the growth, it's about the income. So you're getting a lot of the same companies, but instead of putting all the money into the share appreciation, you're getting that 10% income to either reinvest somewhere else or to live on. So sometimes overlap's not bad. Again, there's a lot of little nuances, and you have to know what your goal is. And that is the whole point of really getting to know your own personal finances. Um, yeah, wholesale time. When I see a dip, I'm investing more. That's why people like Warren Buffett are sitting on, well, there's a couple reasons, but he's sitting on billions in cash because he feels like the market's overvalued right now. And it's different. You and I, we might look to invest 100 or $10,000, or maybe we get a big bonus and we got, hey, here's 20 grand I want to invest. That's easy. You can go to any company in the stock market and throw 20 grand at it, and they're happy. You can't just go to any company and say, hey, I want to buy, $5 billion worth of stock. So his situation is much worse, or not worse, much more difficult to find good deals. But the other thing is he holds cash for that when it's on sale. When COVID hit in March of 2020, I was excited when I saw some of the dips in areas that I really wanted and was able to throw in. At the time, I happened to have my hands on a pretty good chunk of cash and was able to throw in a nice chunk on some stuff. And, by June, July, it was back at where it was before March. And then obviously it's way past that now, which I was excited, but a lot of people, what they were doing in March of 2020 was selling, panic. If I'll kind of close with this, if you're, into investing, the news cycle is going to be your worst nightmare. Avoid watching the news. So, anyways, let's recap. We have FXAIX. If you're only going to pick one fund, I think that's a good place to start, or an entire market fund. SOXX is my exposure to some hyper growth, up and coming AI technology. JEPQ is my get some income driven uh, technology growth, but kind of has the lower downside. You won't get as much upside on JEPQ, but it protects against the downside and you're getting that income. Then SCHG, SCHD are my, if I had a two fund portfolio and that's all I could pick, those would be the two I would pick. And that's my long term goal. I encourage you, if you have questions, thoughts, throw them in the comments. Share this video with your friends. And I appreciate you joining me on Simply Money. I hope you find these videos encouraging and helpful. And I will see you next time on Simply Money.